Thank you so very much to everyone for being here today. What an awesome morning to start off our conference. I just wanted to reiterate how happy we are to have collaborated with Susan, with Jyoti, with the IGIDR to get to organize this incredible festival of freaky, geeky finance for 2018. It really has been such an enormous pleasure to be involved. Okay, so as we kick off this three-day celebration of finance, let me ask you guys this question. Would you like the good news first or the bad news? Good news or bad news? What would you like? Good news or bad news? Bad. All right, let's do with the good news. Let's do with the good news, right? So the good news is, happily, we're going to have an amazing lunch. It's going to be great. Great talk from Coase. Save your space for dessert. Diabetes will lose. So it's going to be a great day. The bad news, unfortunately, as we navigate these crazy times in our lives, is of course everything else. So let me take you guys back. To a day in October, October 15, 2014, and this was a day that started off pretty much like any other day. Right, on this day, there'd been some little bit of bad news, some bad retail numbers coming out of the US, but really nothing too spectacularly awful. And yet, as the kind of nerdy traders gathered at 9:30 in the morning, right, the prices of US treasuries suddenly surged. Right, the yields on these treasuries fell, they crashed really, really suddenly, and this event continues, right, to defy explanation as to exactly why it happened, right? And this weird flash rally, right, this anomalous event in the U.S. Treasury market that remains unexplained to this day, right, this is not an isolated incident, right? This kind of event is happening ever more often, right? And this happened in June 2018 of this year. And of course, right, there's an argument for saying that, look, we should not worry about flash crashes and flash rallies, right, these little events that keep happening in the market. But really what these are telling us in the context of US Treasury markets is really to step back and think and look more deeply as to how these markets are actually working. Right? Look under the hood of the US Treasury markets to try and work out exactly how this market is working and whether or not, most importantly, right, whether or not our regulatory framework, both public and private, right, whether or not it continues to be well-suited, right, resilient, safe, and completely foolproof to deal with the new and emerging changes that we're seeing in the structure of U.S. Treasuries trading owing to the new technologies that are coming up in this space. So we all know, everyone, we all know how incredibly important the U.S. Treasuries market are, right? So without kind of sounding too USA about the whole thing, I think we all understand, right, the incredible significance of these markets. One could even call them the Wonder Woman of all securities markets, of course. I have to do this. I just have to. I can't help myself, Susan. As we all know, right, the U.S. Treasuries markets are the major ways in which the U.S. government funds itself, right? It has become the risk-free, as Dermot was talking about, it has become the quintessential safe asset, right, in following the financial crisis, right? U.S. Treasuries are considered to be so risk-free and so liquid, right? They're essentially, basically fungible, substitutable with cash, right? They're the equivalent of cold green dollar in our hands, right? So these U.S. Treasury securities are incredibly important for the safety and the operation of the global financial markets. And actually, following the financial crisis, right, the significance of this market has grown over the last decade. Right? We had outstanding U.S. marketable debt of approximately $5 trillion in 2008. Right? Today, this figure stands closer to $15 trillion, right? Showing an increase of around $1 trillion a year right, for the U.S. to continue borrowing to deal with the macroeconomic conditions following the financial crisis, as well as, of course, managing the financial crisis itself, right? And to be perfectly clear, the U.S. is continuing and will continue to increase the level of marketable U.S. Treasuries in circulation. All right, for those of you who have a life, who do things, who go out, who walk on Worldly Beach, attend Ambani weddings, right, and who don't spend a lot of time thinking about U.S. Treasury markets, right, this market is kind of weird, right? It's a kind of weird market. So the U.S. Treasuries issues debt to 23 counterparties, 23 big investment banks and banks that are the primary dealers that are designed and pre-qualified to buy U.S. debt because they're considered to be a really safe counterparty for the U.S. to transact with. Right, and then these 23 investment banks, these primary dealers, go out and offload this debt into the secondary market. One part of that market is client-facing, right? That is the primary dealers transacting directly with clients like Susan, like Randall, like Dermot, banks, countries, mutual funds, you name it. Right? And then the other part of the market is when the dealers are interacting with each other, the inter-dealer market. That is when they're managing inventories with each other. And that is a really, really, really important part of the market because that is where we get liquidity in the inter-dealer market and where we have price discovery in the U.S. Treasury market. Right? So that is basically how this market has worked pretty much since Alexander Hamilton, it seems, right? Pretty much since forever. Right? So this has really been a market that has been spectacularly boring, steady, normal, safe, believable, and predictable. Trading has taken place over the phone, right, over the counter, using requests for quotes over screens, right? This is a super boring market, right? At least until now. And what my paper really seeks to argue is that the traditional structural safeguards that have underpinned U.S. Treasuries trading are really breaking, are really straining in the wake of the changes that are coming up in this space. Now, one thing I should mention before I go on, right, is that the presumption of safety in the U.S. Treasury market, the fact that we believe them to be completely and utterly risk-free, the fact that their trading mechanics have been steady for a gazillion years, the fact that trading has taken place over the phones, right? That this presumption of safety has led regulators to take a very hands-off approach to the U.S. Treasury market. Right? Unlike every other market, like equities or derivatives, the U.S. Treasury market, it might surprise you to learn, has no primary regulator. Right? Regulation over this market is divided between the 5 or 6 major regulators. It changes every day. Right? The SEC, the CFTC, the Fed, the New York Fed, the Treasury, the OCC, FINRA, the private broker-dealer regulator for the U.S. Right? These guys, none of them have primary authority over this market. In addition, right, every one of you who deals with U.S. securities regulations, you know that they throw a big fat Indian wedding worth of a rule book at you if you want to trade equities, bonds, and derivatives. But the size of that rule book in the U.S. Treasury market is much thinner. If we look at the FINRA rules that apply to trading in equities, there are thousands and thousands and thousands of rules there. Out of those thousands of rules, only about 69 of them, 70 of them, apply in the context to brokers who trade in U.S. Treasury. So the regulatory framework is much thinner, much looser, that applies to people who trade in treasuries than it does to other kinds of securities. And I would argue that that really is a quite interesting and slightly worrying phenomenon given what is happening today. Now, over the last 10 years or so, what has happened, as I think we'll hear about throughout this conference, is the arrival of automation and high-frequency trading in U.S. Treasury markets, just like it has in almost every other developed trading market, right? And this caught the regulators by surprise. As the flash rally in October 2014 showed, right? Automation today, algorithms, HFT, is now responsible for around 60% of all treasury trading volume in the interdealer market. And this figure, this scale of HFT trading in the interdealer market has really caught regulators completely off guard. Right? The specialists in this market are no longer the 23 primary dealers. They are, in fact, the HFT specialists, the high-frequency trading specialists, firms like Jump Trading, firms like Citadel, until recently firms like Tesa Technologies, that are not household names by any means, but that now mediate, several $100 billion worth of treasury trading volume every single day. And that is a fundamental structural change, one that I think has some significant implications for the safety and regulation of this market. In particular, I think regulators are facing new risks. Firstly, right, there's the risk of information asymmetry, right? The risk of information deficits. Now, before, one could argue that we, the people, right, regulators, we knew exactly what was going on in the U.S. Treasury market. It wasn't that much of a mystery, right? The U.S., at least until recently, right, has been a very reliable, safe, and predictable debtor. Right? The U.S. has been the safest of all safe kind of countries to which you could lend. Right? In addition, we have a market structure that has remained virtually static for the last 50 or 60 years. We have traders, the primary dealers, who are the biggest Wall Street banks and investment banks that we know and trust, to intermediate every single stage of this process. Information asymmetries in this market arguably have been pretty low, right? But that is changing. That has changed, right? Firstly, we're dealing now with the inclusion, with the flourishing of algorithms in today's markets, HFT algos in today's markets. And make no mistake, that is a wonderful thing on very many metrics. Right? HFT can help make markets super efficient at reacting to new information. It can make markets super interconnected as these market makers are able to transact across many different asset classes, arbitraging away differences in the pricing of different kinds of assets. Right? This is a wonderful thing on very many metrics. At the same time, as I think we all also recognize, algorithms introduce new risks to the U.S. Treasuries markets as well as securities markets. The fact is that algorithms can be subject to endemic error, particularly when they're working at very high speeds. Right? Furthermore, we know that algorithms can react in similar ways to new information as it comes in. And arguably, this risk of correlated responses, right? This risk that algorithms would use similar models, react similarly, right? This risk is arguably more magnified in the context of U.S. Treasury markets more than any other, because we're dealing essentially with transacting in a single claim, right? A claim against the U.S. government. We're all transacting at roughly the same moments when the U.S. releases reports about unemployment, interest rate increases, right? The retail spending, the latest tweet. Right? We are trading approximately at similar times, and so there's a danger that we may have correlated responses. Furthermore, what will be the impact of interconnected algorithms, right, and the impact in the U.S. Treasury market? Today, information flows very, very quickly between different marketplaces, but so do the cost of errors. Right? Errors can spread through the different exchanges, different asset classes, different sort of markets at extremely high speeds, far faster than we can react to control them. And to understand the impact on the Treasury market is something that is incumbent upon regulators to take account of in this space. Now, of course, one can argue that this problem, right, is not news. Right? Regulators face the risk of informational deficits, informational asymmetries in markets in all securities markets, in equities and derivatives and so on. But here I think that the risks of information asymmetry are particularly unique because here we're dealing with regulators that do not actually have any primary regulator. Right? We have multiple different regulators interacting in this space. Right? And so there's a really high cost to coordinate. Right? There's a really high cost to coordinate between regulators to arrive at some kind of taxonomy of what are the risks that we think are problematic. right, to then design some kind of system to deal with it, right, to come up with enforcement strategies that might apply to these risks, right? We are dealing with 5 big regulators in the US markets, and if you have any familiarity with that, we'll know that coordination costs are high. Furthermore, agency cultures are different. The constitutional basis of these different regulators is all different, right? And so one can imagine that coming up with a plan to regulate HFT in US Treasuries is going to be really, really hard. And furthermore, right, the private self-regulation that this market has kind of depended on in the past, right, that too is weakening. Right, we've always relied on these 23 primary dealers to mediate at every single part of the process. And now that part is slowly changing. Right, in the interdealer market, we now have the primary dealers, but we also have this brand new group of HFT traders that are coming in and jostling and hustling for business. Right, and that creates a risk. Right, the primary dealers now, right, are in a position where they're fighting for business. Right, the primary dealers today have no incentive to work with the new HFT traders that are also the new cats in the market. Right, and furthermore, with these reduced incentives to cooperate is the fact that the HFT traders are not regulated to the same degree as the primary dealers. Right? The HFT traders are regulated to a much, much, much lower degree. Right? They can leave the market at any time. Right? The exit costs in this market are very cheap for this group of HFT traders. They're regulated to a much greater degree, so arguably there are incentives to take risks, right, where the cost of this risk-taking is shared within the market as a whole. Right? So the private self-regulation, the club, the kind of cabal of people that have always been in this market has really weakened, where these new HFT traders are coming in, where they're operating, and where they're able to leave at any time that the market gets too turbulent for their algos to be able to cope with. Right? And unfortunately, I left the paper mid-sentence because I wanted to go to Whirly Beach. And so I couldn't get to this sentence about implications I frankly don't know. And so I'm still working all of that out. Now, one of the things that I think we can all think about is what would happen if Treasury market structure doesn't work. Right? As Dermot was just talking about, we're really depending on high-quality liquid assets, i.e. US Treasuries, to really retain the value that we think that they are supposed to be vested with. Right? But what happens if US Treasury market structure does not work? If the HFT algos leave, if there are flash crashes, if the market is unwilling to buy and sell when we think it should, right? What happens then? And, one potential worry in this market is that these kinds of instances of shock, right, of potential disruption, we can foresee becoming more frequent, right, as we see the global geopolitics in this market become ever sharper. Right? Increasingly, we're seeing politics being played out in the US Treasury market to say Russia dumps its holdings of US Treasuries. What happens if, say, China decides to do the same? Perfect. Right? So the implications of maintaining market resilience in the US Treasury market for reasons of financial market stability, geostability, general macroeconomic stability is obviously a question that I think we need to answer and have regulators pay some very close and careful attention to how they design this market structure. I think I'm done. Actually, I just put the picture of Susan back up, I think.
No, thank you. Thanks, Isha.
Thank you guys so much.
First of all, thank you for giving me the opportunity. It's a very interesting paper, perhaps one of the most comprehensive discussions on US Treasury market, its history, and the reason why people hold US Treasuries. It's very interesting. I mean, I've been a bond trader for almost my entire life, working life. It's very interesting to me that some of the technological changes that we've seen in other parts of financial markets, how immune the US Treasuries market has proven to be to those changes. And I'll take you about 18, 19 years back, 2001, 2002. that was the time when the first internet boom started, and organizations like TradeWeb, BrokerTech started coming into being. And we in India started thinking about electronification of our government bond market. That's the time when CCIL was brought into picture. And it was felt that the US Treasuries market will undergo a very rapid electronification and automation, and that just didn't happen. And I was surprised to see that over the period of last 18, 19 years, there has been literally no regulatory push, the kind of regulatory push that we've seen in other parts of the markets, to move this market into a organized, centralized, automated, exchange-driven market. And Yash has very aptly pointed out that it remained a domain of these 23 banks who were basically trading in an OTC fashion amongst themselves. Even though, if you talk to anyone, they would tell you that probably US Treasuries market is the benchmark of the most liquid and most tradable market, right? It's interesting to note that the automation that should have been centrally forced upon the market by regulators, as it has been the case in other parts, has actually been brought in by private hands. So the names like BrokerTech have actually taken up that automation and have become private providers of access to the liquidity. And it's through these platforms that the HFT algorithms kind of trade into the market. But the regulation of BrokerTech itself is a big question mark. Because if you think about BrokerTech as an exchange which is giving access to let's say a Citadel who's trading through HFT, then what is the regulation that is applicable upon BrokerTech? I think that's a very important question to ask. If I look at an exchange context, we typically have this layers of regulation. You have a securities market regulator, and then you have an exchange, which is a marketplace and is a regulator in a way, a regulator of its own members. And then you have the exchange members, and then you have the clients. So one question to my mind that is worthy of asking is that in this entire context, what do these dark pools of liquidity like BrokerTech do? How do they behave? And first, what facilities do they provide to their clients? And how does the provisioning of that facilities impact the liquidity in the US Treasuries market? I think to me that's a very, very important aspect that needs to be looked at. I understand this is a draft of the paper, but I was just thinking that it's a very interesting insight that you have gathered from the flash crash or flash rally. But if I were to kind of think about how do we kind of take it forward in terms of the next steps, so it's established now that the US Treasuries market is no longer, in terms of trading volumes at least, maybe not the holdings, but trading volumes, the secondary market trading volumes, is no longer the preserve of these 23 investment banks, but HFT traders and non-bank entities and private pools of capital are providing an increasingly larger amount of secondary market liquidity. The question that is not becoming very obvious to me is that how should the regulation change in response to that? What are the lessons to be learned from regulating similar markets where there is a wider spectrum of players who are participating in the markets, for example, the equity markets, the commodity markets, the FX markets? What aspects of regulation from those sides need to be brought in here to make sure that the market integrity is maintained and you don't have essentially fraudulent and manipulative behavior in the US Treasuries market? So that I think is one direction that your paper can take, right? The second aspect that I kind of was thinking was that there is obviously a panoply of regulators that oversee, in some sense, this market. why is it that the US regulation has not moved in a direction of creating a very cohesive, centralized trading marketplace? Because the thing about a centralized trading marketplace like an exchange is that if you have a well-regulated exchange, the need to regulate who accesses the exchange is that much lesser. Because the data and the market discipline that you require, you actually enforce upon the exchange. I mean, I'll take an example that typically in equities, right, we don't really go ahead and regulate an individual except for saying that thou shalt not trade on insider information. Thou shalt not engage in market manipulative behavior of any kind. But this is like very light touch. Nobody comes and audits an individual to say what you did, right? Unless and until the exchange data reveals that there has been a manipulative and fraudulent behavior by some individual or some private party, right? So your first source of regulation is information available at the exchange and how the exchange is sort of dealing with that, right? I'm wondering whether that's the direction that US Treasury markets or government bond markets in general need to take, right? And it's very interesting to me that why it has already not taken. I mean, a market which is supposed to be the global benchmark, right? A marketplace which is supposed to be the global benchmark for liquidity, why has it not taken that step in last 25 years, roughly, of automation that has so deeply hit the other sides? So that's I think the other direction that maybe your paper can take. Now, just 2 minutes on some of the lessons for India. I think we centralized and we sort of made this market, our government bond market, very automated about 15 odd years back, 17 odd years back. And in some senses, the central bank took the onus to do that and thought that it needs to do away with this broker-dealer system completely. So we have this centralized marketplace, which is highly automated, probably the only large government bonds market in the world which trades on an anonymous order matching system, where the differentiation of a role of a so-called dealer or market maker and an end investor is not that high. And unlike in other government bond markets and bond markets in general, the role of liquidity provision by big banks, by so-called market makers is actually fairly little. But we haven't seen the kind of prevalence of electronic trading, HFT kind of trading that is there, partly because the platform is closed loop and nobody can actually build an algorithm to go ahead and trade in government bonds market, right? That access is just not allowed. Even though at the current stage I see very limited implications for a market like us from your study, but I think it's quite useful to, in general, think about as and when our markets open up to that kind of that kind of trading behavior, what is the regulation that needs to be built to encourage A, bringing in that kind of liquidity, and B, what lessons we can draw from other such markets. I'll just stop here. Thank you very much.
Thanks, Neeraj. So can I open the question to the floor? There's Venki, there's gentleman at the back, and there's Pradeep, and there's me. Thank you. Sure.
Sorry. No, this question is for Isha. I think there is quite a bit of confusion between electronic trading and high-frequency trading in the bond markets. So I think there's a lot, like even primary dealers, if you look at their trading, a lot of it is electronic. But I think what you are talking about is the high-frequency trading. And I think high-frequency trading in the bond markets is, to a large extent, it is a sort of either an arbitrage strategy, which is cutting across different types of exposure to the fixed income space, or is it's a multi-asset class strategy. For example, we used to trade where you're trading risks that you can extract out of equity or options market and use the bond markets to hedge. And so there is quite a bit of delta hedging and that sort of thing which happens. So to that extent, what you're seeing as crashes is, I mean, because we don't know what was the magnitude. So my understanding is that when we talk anecdotally to bond traders, there was quite a bit of movement happening even in the pre-electronic days. It's just that, this is amplified in a shorter range. So I view this as a good news because the resilience of the market is now very high. So it bounces back much higher, much faster compared to what it used to be. So I think, the regulation part aside, which I think we should look at it, how do you regulate a market where multiple players transact and it is across boundaries, national boundaries, But I don't feel the risk, the way the portrayal of the risk in the markets because of high frequency trading. So I think that is still much smaller, and I think it's a lot easier for regulators to get to the 5 or 6 large players very quickly here compared to, let's say, equities or somewhere else.
So I guess my question was for Dermot. In Europe, we've seen the CCP, the Central Counterparty Clearings, kind of become competitive post-MiFID, so they can start competing with each other, can choose where it cleared, which kind of leads to these inter-clearinghouse connections. And I wonder if we really want CCPs competing with each other, because it seems that we may end up in a situation where we get a kind of race to the bottom, where I provide even less for that waterfall and charge kind of less along the way, so that when we get a default situation, if we've all gone to the kind of cheapest clearinghouse, but they've provided the least for this systemic shock, if that's maybe a problem that we face as we move to this sort of fragmented clearing market.
Can we just take Pradeep's question and
The judge had a question.
Judge Kent's question? Pradeep?
I have one question, comment in relation to Dermot's I found it very interesting, the idea that you have this variation margin with only the high gain being retained. So essentially, the CCP retains any gains which are there, of course, for the duration of the contract, irrespective whether you are, whether you're on the long side or the short side. And that, to my mind, has to distort the pricing of the forward contract, because it increases the transaction cost. It will increase the no arbitrage window because of the fact that you would lose interest on that money for the duration of the contract. So that would have pricing implications and therefore efficiency implications. So that's one. So you would have benefit in terms of supporting the default scenario, but at the same time, it will distort the pricing of the contract. My second comment is in relation to the Treasury market, and it's I think it's very important for the Treasury market to have. I'm not sure how the prices per se are reported. If the prices per se are reported as last transaction prices, rather than as the because it's not a dealer market, it has to be that way. It must be the last transaction price that's reported, which is causing this these micro crashes and so on. Now, in the context of, say, the U.S. Treasury market, one has to note that the average size of the trades is very, very large, while the median size of the trades is very small. So, for example, in my work on UK government bond markets, in my paper, I remember that the average size of a trade, of government bond trade in the United Kingdom, was of the order of about 500 million pounds, while the median size was 68,000 pounds. So there was just no comparison. Now, if your pricing is based on the last transaction prices of the large number of small trades that are taking place, it doesn't really, it distorts what you see as being the effect of what is happening. But in the context of Treasury markets, I think, US Treasury market, I think it's very important to have firm obligations and a market with dealers and affirmative obligations, because it is of tremendous consequence to virtually all other assets. that we have prices which are based on effectively bids and offers, or the midpoints of bids and offers, rather than on last transaction prices.
Judge Jordan?
I don't have the depth of understanding the markets that the financial professionals here have, so this might be a simplistic or more philosophical question, but a lot of the discussion today has been about minimizing risk as if risk were in and of itself a bad thing. But I thought that the comment made by Sharma Fernandez earlier with respect to the rating agencies bears some thought across the whole system, and that is there's no skin in the game, and that's a problem, right? You've got the mortgage crisis in 2008 because risk is separated from reward, and in taking the mortgage pools and dividing them up and then not having any risk for rating agencies to say these are AAA rated securities when they were really trash leads to a gigantic systemic problem. So is the problem not that we're not effective in mitigating risk, but that we're not effective in understanding how to appreciate risk and where to lay risk so that behavior is optimized? People are sensible in the deals they make. And that would go to the broader question of how you manage these waterfalls, right? Who's responsible in the end? Maybe there are parties that ought to be responsible in the end, and mitigating the risk isn't the right thing to do. Let them bear the risk, and then the behavior is appropriate to the market. That should go maybe to the Treasury issue, because are high frequency traders not bearing enough risk because they can get out of the market too easily? Or do we say as a society, because there's no such thing as a free lunch, as a society we say we like the liquidity of high frequency trading, so we accept the risk of flash crashes because that's what goes with it. Those are questions I guess policymakers are going to have to wrestle with, but the fundamental idea that somehow risk is to be minimized, I wonder if that's, taken a little bit to an extreme. Maybe risk needs to be embraced because that's the best break on the system. That's the best stability we've got. Well, that's more of a comment than a question, but I put it to you, I put it to Dermot. Are we running away from risk when we ought to be embracing it?
I'm going to toss the last question into the pot, which is the refrain that often comes to my mind when I think about how these kinds of questions are dealt with in India. My first response is, if it ain't broke, don't fix it. And the question that I would like to ask both Dermot as well as Yesha, right? You had one event, and the policymakers chose a path. We're now quite far away from 2008 when they've been pushing for this. Do we have evidence based on which we can actually come up with a quantitative measure about how the new system is imposing both a cost as well as a benefit? So can we measure this in some tangible way? Because I think at the heart of a lot of what is the discussion on regulatory governance, how do you make good regulations? It would be great if we can stand it on the base of a cost-benefit analysis. So for both of you, right, after 2008, this thing has been put in place. Do we get any kind of evidence based on which we can come up with a sense of a quantity on the cost and a quantity on the benefit? Similarly, Yesha, for you, I understand that these episodes happen. I'm curious about where it is that it shows up as a cost. And clearly we think that we understand there's a benefit because we talk about this amorphous thing called market liquidity. At some level, I think that as researchers, we must sit down and quantify it because, as Pradeep said, there are these bid-offer spreads. They seem to have gone down. But in the end, if society is really concerned about high-frequency trading and the prices going through strange distortions that they didn't earlier, where are the benefits, where are the costs? And can we put down some analysis of what happened in the market around that flash crash, right? Did local fund managers freak out? Did global fund managers freak out? Did central governments who hold these securities, did they indulge in very large moves away from holding US? I'm just curious because this should be the data that we should be able to access to and put together a cost-benefit analysis. My last comment. Dermot, would you like to?
Thank you. Okay, a lot of interesting things. Let's start with the competition between CCP's question. I think I think the answer to this is it's really a question about how governance structures work in CCPs. And competition is perhaps illusory when you take into account that there's a standard cookie cutter model for how you operate a CCP these days, which is laid down in international law. You're basically not permitted any longer to run a CCP on the basis that you think is best, having sort of thought about it methodically, and you've actually got to follow the international model. And that means, and if you don't follow the international model, then you won't get recognized by ESMA in Europe, and that means you won't be able to accept any European banks as clearing members, and that will kill your business model. So basically, you've got to follow the international blueprint. And is that bad? It's not necessarily bad, but it does mean that things like the relative size of the amount you take in initial margin or default fund is actually laid down for you. You don't get any choice about that. You have a degree of clearing member governance, which means that I think that's going to act as a degree of a brake on sort of, you know, the wackier ways of racing to the bottom and so forth. And also the other thing is that there's a paucity of risk models out there. CCPs don't. There's basically only 2 risk models that I'm aware of that CCPs use for assessing the amount of initial margin they take. So, you know, frankly, there's not really competition's kind of probably it's probably more about fees than it is about anything else at the minute. So I don't think there's a risk of a race to the bottom, and that's consistent with what I hear from clearing members as well. So whether it's a good thing in principle, if you took away some of that sort of straitjacket, I take your point completely on that. Variation margin gains, haircutting, and price distortion. I would love it if somebody had actually done some modelling. I mean, maybe there is something out there, but if there is, I'm going to confess to ignorance about it. It would be really good to know to what extent we can actually plan or predict the behaviour of prices in markets where some distortive factor like variation margin gains, haircutting is going on, because as you say, that if it's going to impact the prices, what that means is it's going to impact the behaviour of the clearing members that participate in an auction for the bad book that the CCP is trying to sell off. The only reason it's doing variation margin gains, haircutting is because it's not been able to rematch its book. It's still dependent on the clearing members to help it restore itself. And if its own behaviour is changing the prices in the marketplace, that's also going to affect the incentives that the clearing members face. And so I've got myself into a bit of a maelstrom where I don't know, it sounds like a differential equation to me, but help, economists, help me please here. It would be really interesting to see how that follows out. So if anybody does know of any papers where that's been actually modelled out, I think I'd certainly like to be enlightened, please. But it sounds like a really interesting problem. Costs and benefits and evidence. The problem with the 2008 settlement, if that's what we call it, is that it has taken 10 years to roll out mandatory clearing of OTC derivatives products. So it's a process that is still actually ongoing, and that means that it's really quite hard to get anything other than anecdotal evidence on it. What we can see from an anecdotal perspective is that there are fewer, the size of the marketplace in terms of number of participants it shrunk, which would imply that there are fewer people who can see a good outcome of the cost-benefit equation, but that's not helpful to you who wants a hard number on it. I also think that some of what we're talking about is about contingencies. It's what happens at the end of the tail. And I'm not sure that if a CCP is unable to price that, very effectively, these end of waterfall events, then it's going to be any easier for clearing members to price the costs of these remote contingencies either. So particularly anybody who's worked for a bank knows that you don't really care about anything other than the next quarter's results. I mean, you don't really care about anything at all. The idea that you might be spending serious amounts of brain power and expensive quant modelers' time thinking about something that might be a once in a 20-year event. I mean, it's just not going to compute. So I think we are dependent on the academic economists to actually help us with that cost-benefit equation. So I'm not aware of anything out there yet that tries to answer the question, is mandatory clearing a good thing? There's been plenty of sort of philosophical discussion around this, and your points about risk and reward and whether we have the balance right and so forth. There have been, I mean, and it's people like me that write the papers like that, but what we really want is something with some hard numbers in it, and I don't see that happening yet. It would be great if somebody's doing it. Again, if anybody's aware of anybody working on this, please let me know, because I'll be very interested. Thank you.
Firstly, I'd like to thank Neeraj for his excellent comments, very insightful comments. Just to go back to the questions, I think two of the big framing questions that the judge asked and Susan asked was in relation to thinking about who should bear the risk, and also in terms of Susan's point is how we should think about the rules that should govern who bears the risk. And I think right now in the Treasury market, we actually just don't have the tools to come up with that. One of Neeraj's comments was that, why haven't we moved to a central limit order book on an exchange? BrokerTech, mediates around 60 to 70% of all interdealer volume. And yet it is basically unregulated. It operates as an alternative trading system that transacts in treasuries and therefore is exempt from most of the regulation. So the kind of private regulation that the New York Stock Exchange or NASDAQ or other exchanges do as a matter of routine, the risk management that they have to perform, it's really not something that is incumbent upon BrokerTech as a trading platform to actually have to do. That leads to Pradeep's point in relation to transparency, which is actually ironically also kind of missing in US Treasury markets. The rules for transparency for primary dealers to report only really came in after the flash rally. The HFT traders that are not FINRA members don't have to report at all. And so there's this kind of informational deficit that exists in that space for us to really come to the understanding of just to get a basic picture of what the transactions look like. In the client to dealer market, the reporting is extremely minimal. And so I think that kind of leads into Venki's point, which is how do we understand the risk of algos sufficient to be able to just create the circuit breakers, the resiliency mechanisms that are common to other exchanges that are transacting in algos. And one of the major issues that I have is in relation to the tension that exists in the Treasury market between treasuries as a securities trading mechanism as well as treasuries as a financial stability mechanism. And that tension means that the cost of small errors can be extremely large in the financial stability standpoint. So we see in the case of equities, we have Knight Capital, we have the flash crash, we have quote stuffing algos, we have cornering algos, we have all sorts of interesting strategies that operate in that market. And they are also coming into play in the treasuries market, albeit to smaller extents. The question is, are we willing to live with the cost of what happens if something goes wrong? In the case of Knight Capital, the flash crash, exchanges kicked in to reverse certain transactions, to maintain transaction flow, to have circuit breakers. We also have central clearing in those markets. All of that is missing in the US Treasuries market. So the backstops that would normally exist to protect markets in the case of securities just don't exist in the case of US Treasuries. And furthermore, we lack the tools in transparency as well as in central limit order book private self-regulation to be able to get an idea of how we should make that work. But again, I think, all terrific points, and I'm really super grateful for all of your comments.
Can I just follow one thing in the treasuries and currencies, right? I mean, the private information is very small. And so to that extent, I think the risk can easily be taken because the resiliency there's enough people to come in and say this is not private information. They can provide liquidity if prices go out of whack.
No, I'm sorry, I disagree with that. As a trader, I can tell you that there's an enormous amount of private information that can come into play in these markets. That private information may not be about the contract, about the, let's say, the macroeconomic data, but it may be about who's trading what. And that's enormously useful private information. In fact, part of the reasons that I believe that these markets have not electronified or you don't have a central limit trading kind of system is because these 23 guys make so much money from this private information that it is not in their interest to get these markets become a central limit order market. Sure.
But Neeraj, so I totally get what you're saying, but now I want to go back to her fundamental stylized fact. 60% of the trading is algorithmic, okay? Now, we saw what happened on the equity market, that the institutional investors all asked for algorithmic execution because you don't want to show your hand even to the securities firm that is intermediating the order. And I thought that was a very big milestone because at that point, really, there is no information leakage from the buy side. The buy side is running Anant Madhavan's code, sitting inside the co-location, and the intermediary firm knows nothing about what is going on. So once you move to an algo world, I think that changes the political economy of the profit rates of the dealers. And I think that's a very fundamental development in this industry.
I completely agree with you. I think the disincentive that was there for us to move towards a completely electronic center order limit system is actually reducing quite a lot, quite sharply. So I'm surprised why the regulation there is not moving to give it that final push, to especially given the kind of issues that you kind of raised about the high frequency trading. Sorry.